Greetings. This is Doug with Community Lending Group. And for this special mortgage moment, I wanted to share with you our forecast for 2023 when it comes to the housing industry and interest rates. Now, I wanted to share this in light of all the questions I've been receiving over the last 6 months from my clients asking me, when are rates going to start finally coming down and what's happening with the housing industry? Should I buy? Should I sell? Should I wait? Now, although the future is always uncertain, history does leave clues, and we can learn from those clues. And it's from these housing clues that we can see the direction that the industry is going right now. Now, one of the industry leaders that I like to listen to on a daily basis, he has put together this information, and I think you're going to find it very helpful in helping you know what you should be doing for this upcoming year. Now, unlike most of my videos that last 2 to 3 minutes, this one's going to take a little longer, so you're going to want to set aside some time. But I think it'll be worth your time if you just bear with it, because it's going to paint that clear picture as I shared. Now, bottom line, there is some great news on the horizon when it comes to the housing market and interest rates. Now, much of the problem started last year when we saw inflation hit 40-year highs. And so to truly understand what direction we're going, we need to take a peek at how inflation drives mortgage rates. Now, on this chart, you're going to see a 5-year history of inflation rates. You'll notice this bottom pink line represents the core consumer price index. Now, this index is reported each and every month by the Bureau of Labor Statistics, and it calculates the weighted average of price of goods and services in regards to the U.S. consumer spending. Now, this top line is the 30-year fixed mortgage rate. Now, notice that when inflation goes up, interest rates go up. When inflation dips, rates dip. However, this period right here needs to be explained. Now, when the Federal Reserves change interest rates, it does not directly affect long-term interest rates. Instead, it affects short-term rates, things such as your prime index rate, home equity lines of credit, or credit cards. However, when the Fed spend billions of dollars buying back mortgage-backed securities, that does have a direct impact on interest rates. And that's a period called quantitative easing, or QE. And so the Federal Reserve artificially kept rates low around 3%. Now, you'll notice that when inflation started picking up right in here, that the 30-year fix should have gone up as well. However, the Feds did not make a change. They believed that the inflation was transitory, it wouldn't stay. However, they were wrong. And when they finally realized that, they stopped buying the mortgage-backed securities. And what happened? Immediately, you'll see that interest rates started going up to keep up with the CPI. In March of 2022, when we saw the CPI come down came interest rates, and when the CPI went up with interest rates. And you'll notice at the very end of this slide, you'll see that at the end of last year, that the rates were on their way down because the consumer price index was on the way down. So we can truly see that inflation is the key in trying to keep these interest rates low. This chart will explain how inflation changes on a monthly basis by following the consumer price index. This allows us to somewhat forecast the direction of inflation. So at the end of 2022, the core consumer price index was sitting at 6%. Now, economists like to use the core consumer price index because it removes energy and food costs, which are very volatile. So, for example, when OPEC limits oil production, when weather changes food supply, that cannot be affected by monetary policy. So they use the core CPI, things that can be affected by monetary policy. So here is kind of how it works on a monthly basis. Now, it's a rolling 12-month average. So each month they're going to be replacing the number from the previous year. So, for example, in November of 2022, when we received the October reading of 0.3%, that replaced the reading of 0.6% from 2021, which is why inflation dropped by 3% in November. And then in December, when we received the November number of 0.2%, it replaced the findings of 0.5% from 2021, which is once again why inflation dropped by 0.3% that month. Now, with the exception, as we look forward, with the exception of March, take a look at the next 6 months. We're going to be replacing 0.6, 0.5, 0.6, 0.6, 0.7% rates with these lower numbers in the 0.2 to 0.3% range, which is why we see that inflation is going to be making a drastic change in the first half of next year. And as we learned from the last chart, as inflation goes down, interest rates will go down. Now, one additional facet that will help inflation drop even quicker is that of shelter costs. Now, fortunately, shelter costs have been coming down, but you can see at its peak about a year ago, they were upwards of 18%. Right now, we're just at 4.6%. But since shelter costs involve leases and leases are stationary for a 12-month period of time before they increase, the consumer price index takes a 12-month average. So even though currently we're only at 4.6%, the 12-month average is at 7.9%. This chart shows the problem that when it comes to shelter costs, because even though the actual number is dropping, the 12-month average is still increasing because there is a lag when it comes to shelter costs. And why is this such a big problem? Because as you can see up here, shelter cost makes up 39% of consumer price index. So with it being over a third of its percentage, and you can see where they were up last year, that's why inflation was so high. Now, eventually, this number will start coming back down again. Kind of reminds me of a roller coaster. Picture yourself on a roller coaster. When you're going up over the top of the hill, those people in the front are going to start going down, but not very quickly because the people in the back are still going up. Now, eventually, you're going to get completely over the top, and then the speed of the roller coaster is really going to pick up. That's kind of where we are right now. Here in January, we roughly hit the apex of when the 12-month average is going to start coming down. So when we look at this chart, it's now going to start coming back down. Now, in the next couple of months, we're going to get over the top, and then things are going to really start to pick up some speed, and the inflation numbers are going to get that much better. Because when you look at it, shelter costs are all coming down. Things such as food and gas and clothing are all coming down with one exception, and that is the shelter cost, because even though it's decelerating, it's still showing that it's increasing in the CPI number because of this lag effect. Now, earlier we had talked about the relationship between inflation and interest rates. Another thing to take note of is the relationship between the 10-year Treasury note, which in this chart is represented by the blue line, and the 30-year fixed rate mortgage, which is represented by the yellow line. Now, this chart shows the history over the past 35 years, and you can clearly see that there's pretty much a close relationship between the two of them. It's not exact, but it's pretty close. Now, the range between the two is roughly 175 to 200 basis points, or in common terms, that's roughly 1.75% rate and 2% rate. So when the 10-year Treasury was roughly in the range of 4%, then you would see mortgage rates roughly in the range of 6%. Or if the 10-year Treasury was in the range of 3%, you would see interest rates that would be in the range of 5%. Now, you can see that this pattern had pretty much been the same throughout the entire 35-year history until towards the end of 2022, when the difference between the two jumped beyond that 200 basis points to an average of 300 basis points. That's 3% higher. So when the 10-year Treasury was around 4%, that's why we were seeing interest rates around 7%. Now, that's a big difference. What happened? Now, to understand this drastic change, you need to see your mortgage more from the eyes of a lender. Now, when you close a loan, you start making payments to a particular lender. Most people would think that the mortgage company owns that loan, and that's not correct. The majority of the time, the loans are sold back to the secondary market to entities such as Fannie Mae and Freddie Mac. However, your mortgage company still maintains the servicing of the loan. They answer the questions from this consumer. They collect payments. They make sure you're not late. They deal with escrow, with taxes and insurance, and then they forward the payments on. And for this servicing, they are paid a servicing fee. Now, for the lender, there is a value in collecting the servicing fee, and they can calculate this value by determining how long they'll be able to service the loan. Now, under normal conditions, these lenders will collect these payments for several years, on average 5 to 6 years. But when the rate started going above 7%, most of the lenders could see the signs of a potential recession, and that if rates were to start dropping again, most consumers would refinance their homes, eliminating this high 7% rate. So rather than servicing these loans for 4, 5, or 6 years, they might only be servicing them for 6, 12, or 18 months, thus lessening their value in the eyes of the lender. So the rates moved higher than the traditional 200-point spread to make up for the lessening of the value the lender would be receiving from their current mortgage. So as the 10-year Treasury continues to drop, as we're forecasting, interest rates will actually drop faster than the 10-year Treasury as more servicing value is added back to the lender. That's because a 5 or a 6% mortgage will stay on the books much longer than a 7% mortgage. And we already started to see this. As we closed out 2022, the spread was already starting to narrow. As the 10-year Treasury moved closer to the 3.5 to 3.75% rate, we were already seeing interest rates in the low sixes. So that spread of 300 basis points was already narrowed to around 275 basis points. So as the 10-year Treasury gets lower due to lower inflation rates, mortgage rates will follow suit. This is actually going to help us get back to a more normal servicing value, and in turn, we're going to see rates get closer to the 5% range in the first half of 2023. Now, I mentioned a few minutes ago the R word, recession. Every sign is pointing towards a recession. Some would even say we're already in a recession since, by definition, a recession is 2 quarters of negative gross domestic product, which already occurred last year. But the problem of knowing when you're in a recession is that it's not official until the National Bureau of Economic Research declares you are or were in a recession. And typically they don't declare it until a year after you've already been in one. It's kind of like hitting one of those speed bumps and not seeing the sign bump until after you hit it. But there are a lot of signs indicating a recession is near. So let's talk about a few of them. Now let's start by looking at credit card debt. This top chart shows the increase in credit card spending until the recession hit in March of 2020. And there was many people that were living on their credit card until the stimulus checks were received. And once they stopped receiving stimulus checks, you can see that credit card spending started to spike until now it's completely out of control. Now, the bottom chart, let's look at the savings rate. You can see exactly when all 3 of the stimulus checks were received, and now those stimulus checks have been spent and people are saving at a level even lower than what they were prior to the recession. Now, when you compare these two side by side, you can see that people were maintaining their lifestyle, but they were either using credit card or they were using their savings to maintain that lifestyle. Now, there's a limit to what both of these numbers can go to, and when we exceed that limit, recession is going to be evident. Another great sign of a recession is an inverted yield curve. For anyone who's bought a certificate of deposit at the bank, typically the longer you keep your money in the CD, the higher rate of return you're going to get on that CD. I mean, we even see that with interest rates. We're charged a higher interest rate for a 30-year loan than, say, that of a 15-year loan. So one of the signs of a recession is when the 10-year Treasury note, which should normally produce a higher rate of return than, say, that of a 3-month note, is actually lower than the 3-month note. So when you take the rate of a 10-year Treasury note and you subtract the rate of a 3-month Treasury note, you're subtracting a smaller number from a larger number, and you're left with a positive number. But when the 3-month Treasury is higher than the 10-year Treasury, and you're subtracting these two, you're left with a negative number instead of a positive number. This is called an inverted yield curve. And when this happens, take a look at the track record of how often a recession follows. So here's a chart showing the spread between the 10-year Treasury and the 3-month Treasury over the last 40 years. Now, right here is our 0 mark. Everything below it is negative. Notice every time we have an inverted yield curve, within a short distance, a recession follows each and every time. And notice where we are right now. We're in a very negative position, which means we're either in a recession or on the cusp of a recession. Now, there's other signs that show that we are heading towards a recession, but let's shift gears. Let's look and turn towards the housing market. Now, housing is affected by that of supply and demand. Now, for the last few years, up until when rates started to shoot up, the supply was extremely low and the demand was very high. This is what pushed the value of the homes up by 20% each of the last couple of years. But when the rates hit their highs of the 7%, the demand started to drop drastically, which in turn caused the supply to start going up. Now, this demand comes from household formations. Now, this number has continued to increase as our population increases, but recently it's been hovering right around 1.7 million per year. Now, household formations occur when someone who's been living with their family decides to move out on their own and buy a home. This creates a new household. Now, when interest rates hit the 7% range, though, many of these individuals went into hibernation, waiting for the interest rates to lower. I mean, I saw this firsthand as many of my first-time homebuyers would come into my office and we tried to strategize about buying in the near future. So that household formation demand went from roughly 1.7 down to only 1.3 million. Now let's look to the supply side. Okay, now let's look at supply because builders have slowed down as well. They learned their lesson from back in 2006 to 2009. Currently, they're finishing roughly about 1.5 million homes per year. From that, we need to subtract about 100,000 homes that are being replaced due to age or other reasons. That gives us about 1.4 million supply to meet these new household formations, which, as we learned from the previous slide, has dropped from 1.7 down to just 1.3 million. Now, this is why we've seen the market slow down, because there's enough supply to meet the demand. Now, what happens, however, when interest rates drop to a little bit more normal rate of, say, 5%? That's going to cause these household formations to increase to a more normal rate of around 1.7 million. That's going to overwhelm the supply, which is going to give you an upward pressure on prices to keep up with the demand. So we're going to see price values go up once again. Now, this is why it's so important you do your due diligence when you're looking to get into the housing market, because if you turn on the news, they're going to tell you we're in a housing bubble and it's about ready to burst. And here I'm telling you we're about ready to see prices go back up. Now, this chart shows that the house prices have increased by over 115% in just the last 10 years. Now, what's interesting is those news reporters that are predicting a housing crash, they're some of the same individuals that back from 2017 to 2019 were predicting that we were in a housing bubble. And yet in the past couple of years, we've seen an increase of over 39% in value. For those who've owned a home these last couple of years, I'll bet you're glad you didn't follow that advice. And yet, even with interest rates more than doubling in the last 12 months, we've still just seen a correction of 2.5%. That's because inventory levels are still relatively light and rents are still extremely high. People still want to buy homes. They're just hibernating, wait for rates to come down. And when the rates do come down, watch what's going to happen to the housing market. That's why now is a great time to buy a house before the rates go down and before values start going back up. Now, another issue created by the higher interest rates and the surging home price is affordability. And this is an important issue that we need to discuss. So let's say that you wanted to buy a home last year and you needed a loan of about $400,000. You would have received a rate of about 3.5%, so your principal and interest payment would have been $1,796. But things have shifted in the past year, and now as we're entering 2023, values have still increased over the last 12 months by about 10%. So to buy a home similar to the $400,000 home, you would need to spend roughly $440,000. Now the rates have also gone up to 6.25%, so therefore your new principal and interest payment would be $2,709. That's an increase of $913. Now on the surface, that's huge, and it is. But there's another half of the equation that the media is not telling you about, so you're not getting a clear picture. According to Fannie Mae, who is one of the major buyers of mortgage-backed securities, they show that the average household income for someone buying this kind of home was a combined household income of $9,000. So this would represent maybe two people making roughly $50,000 each. Now, ADP, the payrolls company, they have the ability to measure over 25 million records, and these records show that during 2022, those individuals that stayed at their job saw an average increase of income of 7.6%. And if they switched jobs, it went up to 15%. So if you're looking at a weighted average, since obviously more people stayed with their job than switching, that means the average person's income increased by 9% this past year, which mitigates much of the increase that we see here. But the household payment is only part of the problem, as you know, because we've also had food and gas and services that have increased at the same time. This is part of the reason people have been hibernating, because although their income has increased, it's not keeping up with the expenses that they're incurring. So many people are taking a step back and they're waiting to see if the dust will settle. But if you want to get ahead in this game, you need to look forward and see where you're going to be next year. So let's start with income. According to ADP, income has been going up at a rate of 7.6%. But let's be a little more conservative. Let's just say it only goes up 5%. This means your income will have gone up from $9,000 last year to $9,800 this year to over $10,300 next year. So you're making $1,300 more than you were last year, and your payments have only gone up $1,150. So you've pretty much mitigated the increase from the market change. Now that as you look back over what we've discussed these past 10 minutes, with inflation coming down and a recession around the corner, it's very reasonable to assume that we'll see rates in the low 5% range, if not in the high 4% range. This would put your new payment around 2360. So this upcoming year, your affordability could actually be better than it was in 2021. So to sum it up, here's our forecast for 2023. Let's start with housing. First of all, we see lower inflation, which is going to lead to lower interest rates. We see a recession-like slowdown, likewise leading to lower interest rates. We see income continuing to increase to help affordability, but we see a very tight inventory level as builders are slowing down in their production, but we see household formations increasing as interest rates start to go down. This is going to cause a pinch on inventory levels. We also see rents continuing to be expensive and rising, which is going to leave very little options. So bottom line, we see low single-digit appreciation for most of the U.S., with activity picking up in the spring and especially in the summer months. Now, for our mortgage forecast for 2023, we're going to break it up into two parts. First of all, the headwinds which will be fighting us, and next the tailwinds which will be pushing us and helping us. So starting with the headwinds, first of all, there is global quantitative tightening. There is a lack of foreign central bank buying and more debt to be financed. I mean, bottom line is the government continues to spend money. The debt needs to be financed somehow, and this is what fuels inflation. I mean, we saw this happen just a couple of weeks ago when the government spent or passed a $1.7 billion bill. Immediately, we saw a jump in interest rates. So as the government throws more money towards the economy, this will have a negative impact upon interest rates. So these are the issues that we have to face when it comes to upward pressure on interest rates. But we still see rates going down because of the items we're going to discuss next. Now for the tailwind items, which are going to help us drop the interest rates. First of all, we're expecting lower inflation, which has already started to drop. But as we discussed, over the next 6 months, we see it coming down much further. Next, we're starting to see inventory build among retailers. This will lead to sales, which will actually lead to dropping of prices. Next, there is an increase in the mortgage service value. Once again, we discussed that the normal spread between interest rates and the 10-year treasury is typically between 175 to 200 basis points, but that's ballooned up to 300 points. We see that coming back to a more normal spread of about 200 basis points. And then lastly, a recession is likely. Now, just as the Feds increased interest rates to slow down an inflationary market, they decrease the rates to help stimulate a recessionary market. So this will, between these four things, we expect to see some great news when it comes to interest rates. So to sum it up, we expect to see that the 30-year fixed rates will hover closer to the 5% range over the first half of 2023, with the U.S. 10-year Treasury hovering near 3%, if not even lower. Now, we've discussed a lot of information here, so if you have any additional questions, feel free to reach out to me. I'd love to help you with the purchase of your next home. I appreciate you taking the time to listen. I hope you have a tremendous day, a tremendous 2023, and I look forward to talking to you real soon.